Negative interest rates coming to Australia. Let's have a look. Hello everyone, I'm Florian.Heise and welcome to another episode of HeiseSays. Grab your stein of coffee because the article that we're going to look at is discussing fears of negative interest rates materializing in Australia. Now, we've spoken about these in the past. Several other countries around the world have negative interest rates. It seems so unnatural and so crazy. We've heard from viewers overseas living over in countries that have negative interest rates and just the impact that does on the ability to run a business. You know, it's to incentivize you to spend, and then other people are rewarded for having huge debt. What could that do to the housing market here in Australia if we went negative? Just dwell on that for a moment. So before we have a look at this article, let's listen to what our very own Reserve Bank governor has said about negative interest rates, everyone.
I don't quite see the trade-off quite like that. And make it clear, I haven't ruled out negative interest rates. What I've said is that they're extraordinarily unlikely.
So he hasn't ruled out negative rates, but they're unlikely. So take that how you will, if we're going to get them or not. Or maybe we just need to wait till we get the next Reserve Bank governor.
You know, in a world that's so uncertain and so fluid, I don't think it's prudent to rule it out, but it's extraordinarily unlikely. And if I can explain why, that's the conclusion we've reached. On the positive side of the ledger, I think the main benefit from negative rates is downward pressure on the exchange rate. If we were to have lower rates, then I think we'd see a lower currency as well. So that's the benefit, and that would be a material benefit. We've got to weigh that against the costs, and there are two here that I'd reference. The first is that negative interest rates, I think in most countries, do impair the profitability and efficiency of the financial system, and ultimately its ability to provide credit to the real economy, which is really important. We're seeing this in Europe now. There are a lot of problems in the European banking system, but they're structurally low profits, and it's quite difficult for them to provide the credit to the economy that's needed. So the banking systems don't work as well with negative interest rates. They would also create distortions in our financial system because deposit rates would effectively be bounded at zero. That's what happens in other countries as well for most depositors.
They pretty much are now anyway, sadly enough.
So a bank that financed itself with a lot of deposits would be a competitive disadvantage to one that finances itself in wholesale markets at negative interest rates. So there'd be distortions within the financial system as well there. So credit supply, I don't think, would be enhanced by negative interest rates. The second negative I just want to mention is that in many countries, there's increased concern that negative interest rates encourage people to save more, not spend more.
That's a real interesting point he's making here. Just think about this. Negative rates, so you chuck more money in the bank to offset the money that you're losing, not spending more.
Imagine I tell you, you put money in the $100 in the bank, and in 5 years' time, I'll give you back $95. That's what negative interest rates mean. And in response to that, we're seeing in some European countries and in Japan, there's some evidence of this as well, that people say, well, because I'm going to get less from the bank in 3 or 4 years' time, I've got to save more. So negative interest rates can become contractionary from that perspective. So reduced supply of credit, and maybe some people save a bit more versus the benefit of the exchange rate. I think in the current situation, I don't think that the cost-benefit justifies negative interest rates. It's interesting. Can I just make one more observation? Since we've had the pandemic, no central bank that's had positive interest rates has gone negative, and no central bank with negative interest rates has gone more negative. I think that tells you that the consensus amongst the central banks is that really there's not that much to be gained from doing this, and perhaps the costs are greater than the benefits. If that consensus were to change, then, as I said, we haven't ruled it out. I think it's extraordinarily unlikely.
So there you have it. That's from our very own Reserve Bank governor. So let's have a look at this article now with that in mind. So, and of course, this is from a gold bullion dealer. So, there is growing view by economists that Australia will experience a double-dip recession over quarter 3 and 4 of this year, with the latest from the CBA calling for a 2.7% contraction in quarter 3. Now, a Reserve Bank governor, the RBA, don't think we'll have an actual recession again. Last time we had a recession, there you go. So what's the definition of a recession? Now, it's a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in 2 GDPs in successive quarters. So one quarter after another falling, really. That's the generally agreed definition of it. Now, some people will say, no, we haven't been in a recession. Worse to come, worse to come. Yeah, no, we may have an even worse recession. And one thing to consider, our GDP growth has been below trend since 2008, since the GFC. And one could argue that extended below trend growth is a depression of the economy as well. But it depends where you pick. So, a recession is 2 consecutive quarters, with New South Wales expected to stay in lockdown until mid-November as CBD's base case, and the likelihood of continued but hopeful shorter lockdowns in other states, quarter 4 seems a real possibility after such a plunge in quarter 3. The chart below puts the single quarter, negative 2.7%, into context, with the entire 1990s recession being negative 1.7%. Okay, there you go. Remember this one, everyone? That's the recession Australia had to have. That's the last recession in most people's memories. We had the COVID recession, and this is CBA's forecast for quarter 3. Boy, look at the 80s recession. Here's the thing, this recession was so long ago, I was a kid. That's when we moved to Queensland from Victoria. That's when construction work in my father's business slowed down, so we moved up here. I've never worked in a recession. I've experienced it in the architectural practice, up and downs. But, there you go. Not an overall recession. And this one seems a bit unusual, maybe because the government is throwing so much money at the economy with home builder and other schemes, and just, racking up a little bit of debt. Whilst most are talking Q3, Q4, NAB last week predicted there could be a shock negative print for Q2 yet to be released. Okay, from the Australian Financial Review. NAB assessment stems from a fall in export volumes over the quarter, primarily iron ore, which is unlikely to offset by an increase in inventories because the slowing stem from production not shipping. Regardless, there is no doubt about what is coming, and the fact that there is debate about whether Q2 will be negative or positive tells you the extent of the misguided everything is awesome narrative. Well, I did like the Lego movie. Indeed, so poor is the outlook that our banking regulator, APRA, was telling our banks to prepare for negative interest rates before Sydney even went into lockdown. We have shared before the tight correlation between the gold price and negative yielding government bonds. Central bank negative rates is not a new thing. The EU has held rates negative for some time, and the likes of Japan, Switzerland and Denmark for many years. Earlier this year, the Bank of England also warned its banks to prepare for implementing negative interest rates. The theory goes that if you have to pay the bank for the privilege of holding your cash, then you will be more likely to want to go out and spend it in the economy, or, of course, further expand the property and share market bubbles by investing there. Well, yeah, they're right. They're right. What do you think would happen here in Australia? If people were charged negative interest rates to hold cash, all the money is going to go into property, guys. Every penny, everything will go into property. That Japan has been doing it so long with little benefit should warn you of its effectiveness. What Japan does have to show for it, though, is the world's highest debt per population. And what has been clear from the euro implementation is that it is damaging to banks as well as it turns their business model on its head. Further to our article on Friday, CBA has a warning 300,000 lost jobs in Sydney alone due to the lockdown, and NAB have the cost already at around $16 billion. However, in stark contrast to this article on Friday, if we do go into negative interest rates, there could be an impetus that even higher house prices as outlined above. That we could have two such opposing outcomes put forward by intelligent analysts highlights the unbalanced nature of the current economy. The US market highlighted this on Friday night our time. The US non-farm payroll saw a monster print of 943,000 new jobs, way in excess of expectation. That saw gold and silver and bonds hit hard and the US rise, or the USD rise. That nearly two-thirds of those jobs were reopening jobs in hospitality and teaching, just as the US starts to reel now in the face of Delta, was not part of the narrative. Well, people don't care. The market doesn't care. The market is about responding to the news and optimism and perception, not a reflection of reality. Reality? Since when did reality mean anything? It's how we perceive reality. Probably the key takeaway is that no one seems to really know what the future holds. For us mere mortals needing to decide where to invest our hard-earned wealth, that is called comfort. You must, however, on any dispassionate assessment, see one thing appears certain, and that is the monetary stimulus will continue. CBA and the above assessment don't see rates rising now until May 2023. One of the tightest correlations, despite any of the above scenarios, is gold. Gold's linked to negative real rates. Whether official rates go negative or not, inflation subtracted from the current near zero or a future negative rate is still well and truly firm and unprecedentedly negative. So, of course, we're seeing this is from a gold bullion dealer, everyone. So you've got to understand what they're putting forward here. But still is an interesting insight into everything that's being put forward. Their argument is that real rates are essentially negative, which is right. When you look at inflation, over 3%, compared to what you get in the bank, what am I getting? I'm jumping through all these hoops at ING to get hardly anything. So what's the solution here? Well, let's have a look. Now, there's a few things. What's going to happen in Australia? Where, if people are worried about inflation, about losing the value of their money, where are they going to put it in? Are they going to put it in gold? Are they going to put it in other precious metals, silver? Are they going to put it in, diamonds? Or are they going to put it into crypto or the stock market? Or everyone's favorite reality TV show, property? What do you reckon? Where do you think it'll head? We've seen already that property is the piñata that the political class will bash to crack open economic stimulus. There's no sign of stimulus ending. There are hints of negative rates, but it doesn't look like our Reserve Bank governor will go that way, but he hasn't completely dismissed it. So what could happen? What's the solution to all of this? Well, obviously, the solution will be to stop the manipulation and let the market correct itself. I can't see there being the political will for that. I'd love it if there was. The best chance we can get is to get more people aware of the damage that it's going to cause if they keep going down this path. Because if they keep stimulating, if they keep reducing rates, if they even go negative, then boom, we're going to see housing go to the moon. Why wouldn't you? Oh, it's a fun time to be Australian. Let me know your thoughts and opinions on this one in the comments down below, everyone. If you're a fan of the channel and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve or AussieBroadband. You can buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I'll see you next time. Bye for now.